Global stocks fall from new record highs and bond yields bounce overnight. The Swiss National Bank surprises with a rate cut. The Bank of England holds as expected, and New Zealand exits recession. Just. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ FX analyst Felix looks at how Japan's monetary policy is evolving.
If we start to see in the preceding weeks up to the July meeting quite a sharp deterioration in the yen like we saw for much of Q1 of this year, that probably does increase the chance of a hike for the BOJ.
But first, in 5 and 5 with ANZ, global stocks are receding from new record highs in late trade, and bond yields have bounced from 2024 lows earlier in the day. Meanwhile, the Bank of England held its key rate as expected, but the Swiss National Bank cut again unexpectedly. Here's ANZ economist Bansi Madhavani.
The SNB sounded more confident that inflation pressures are lower and perhaps even more manageable. What was also notable is that the recent strength in the Swiss franc amid the political uncertainties in France is also contributing to their benign inflation outlook. One thing that we took away from this meeting was that the SNB last cut rates in March, and then they had 3 months of data to decide their next policy move. It is likely that this becomes a template for other major central banks, as in the early part of their rate-cutting cycle, they're likely to move in slow, gradual increments and assess data before pre-committing to an easing path.
Those higher US Treasury yields lifted the US dollar. That saw the Aussie fall 0.3% to 66.48 US cents by 5 a.m. Sydney-Melbourne time, while the Kiwi also fell 0.3% to 61.16 US cents. Number 2, New Zealand's economy exited recession in the first quarter, growing 0.2%. That was above consensus, but in line with the Reserve Bank's forecast. ANZ economist Miles Workman says the underlying details were a touch softer than he expected.
Particularly across services industries. That's a part of the economy which does tend to be quite slow moving, and it does make up about 70% of the economy. And we saw quarterly growth there come in at negative 0.1% quarter on quarter, where we had expected a 0.4% expansion. So I think the upshot here, you can see some clear evidence there that some of those risks associated with sticky services inflation are in fact being mitigated by the simple fact that services industries are indeed slowing, and perhaps a little bit faster than we previously thought.
Number 3, China's main banks have held their best offer 1 and 5 year loan prime rate steady in June. There has been some speculation they may fall in coming months after the People's Bank of China's governor called out some banks for quoting different rates. Here's ANZ senior China strategist Zhao Pengxing.
The interest rate cut outlook will be highly data dependent. We maintain our view that PBOC will cut in Q3 so that the loan prime rate will follow the PBOC cut.
Number 4, Bank Indonesia kept its policy rate on hold as expected at 6.25% yesterday. That's after speculation it could hike again to defend a weak currency. ANZ economist Crystal Tan says the Bank Indonesia's governor attributed that recent weakness to corporate demand for dollars and also views on Indonesia's fiscal outlook as opposed to fundamentals.
BI does expect the IDR to strengthen. It also reiterated its willingness to intervene in the spot, DNDF and secondary government bond markets to stabilize the currency if needed. On the Fed funds rate, BI continued to see a cut by year-end. It is also notable that the governor flagged scope for BI to deliver its own rate reduction if the global environment turns more benign and also if domestic fiscal concerns ease.
Number 5, Taiwan export orders rose a stronger than expected 7% in May from a year ago. ANZ economist Bansi Madhavani credits double-digit growth in demand for AI chips.
We think stronger exports will lift Taiwan's GDP growth to 4.1% this year. Also notable is that the demand for export orders was particularly strong from the ASEAN region. Now, demand has been rising at double-digit growth rates in this year, and what that essentially means is that ASEAN is getting increasingly integrated in global electronics value chain.
Bansi Madhavani there. Now, in our bonus deep dive interview, ANZ FX analyst Felix tells my colleague Alex Tarrant how the outlook for monetary policy has evolved in Japan since the Bank of Japan's April meeting, the minutes for which were released yesterday. Alex will be standing in for me next week as I take a midwinter break. Here's Felix.
April was a little while ago now. Like you say, it does give us a good clue about how or where bodge thinking on monetary policy has come from, where it might, or how it's evolved over time as well. So it's quite interesting to look at still. I suppose the most interesting thing from the minutes was concern from board members about a weaker yen potentially raising inflation risks for Japan, especially on that sort of imported inflation side of things too, and potentially even needing additional policy tightening, so moderate rate hikes to offset any potential impact from yen weakness on the Japanese economy. That was quite different, I suppose, from the tone on the yen that was expressed at the April press conference just after the April meeting by Governor Ueda, who was a bit more, I suppose, insouciant to some degree about yen weakness, saying it wasn't significant in terms of monetary policy impact. And those comments really is what drove dollar yen higher just after the April meeting and ultimately gave it momentum to hit that 160 mark even temporarily. So that was the biggest difference. But even looking at some of the other comments in the meeting, we could see that there was still support, at least from one member, for keeping financial policy accommodative. And overall, the minutes do suggest that further policy normalisation is on the way from the Bank of Japan at coming meetings in the future.
Did we get any clues about what might happen at the end of July?
We did see more recently, Governor Ueda in Japanese Parliament this week did say that the chance of a July hike, it's a good chance at least. I think the really important thing they're looking at the moment seems to be around yen weakness. So if we start to see in the preceding weeks up to the July meeting quite sharp deterioration in the yen like we saw for much of Q1 of this year, that probably does increase the chances of a hike for the BOJ. Again, definitely as a result of those perceived inflationary risks from a weaker yen.
How does what we've seen in the US in the last week, with the dot plot sort of being at odds with market reaction after the CPI figures, how does that play into all this?
Certainly it will impact dollar yen, so elevated US yields and that really wide yield spread between US yields and Japanese government bond yields has been a key factor in keeping dollar yen elevated over the last couple of years. So, the idea that maybe the Fed potentially could not lower interest rates as much as maybe was initially expected this year would imply US government bond yields stay a bit higher for longer, and therefore that sort of keeps dollar yen sort of up roughly around where it is now in current ranges. So that does mean the yen is sort of keeps under pressure, and really to sort of stress the Bank of Japan policy tightening at the moment is really normalization. It's not really akin to what we've seen with other central banks in the last couple of years in terms of tightening there. So for instance, in the US or the UK. So, really the hikes that we're seeing at the moment from the BOJ aren't going to really change the outlook for the yen, at least in that near term.
Because the backdrop is that the Japanese economy is shrinking.
Definitely, and that's something I suppose that maybe would potentially be a cap on the degree to which the BOJ can tighten policy or use interest rate hikes on their own to support the yen. Certainly the domestic backdrop, particularly around private consumption, still is looking pretty soft. We did see Q1 GDP, not a lot of positive details, especially again from that consumption front. So there is a balancing act, I suppose, the BOJ have to consider at some point between supporting the yen if it continues to deteriorate from here and the domestic economic outlook in Japan.
Felix Ryan there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, June the 21st. Alex will catch you next week with a look at proposed changes to how China conducts monetary policy. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.